What if you could see the financial battlefields of the next decade before the first shot is even fired? Well, today, that's exactly what we're going to do. We are diving deep into a fascinating white paper from Carl Finance to run a strategic war game for what they're calling the volatility decade. And we're focusing on the final, most crucial part, Act V, navigating the decade ahead. So let's get our briefing.
Okay, here's our mission plan. First, we're going to calibrate our mindset, get our heads in the right space. Then we dive into the intel, breaking down 4 potential acute shocks. These are the sudden, fast-moving events that could just cascade through the whole system. After that, we'll look at a chronic threat, which is more of a slow burn risk, but believe me, it's just as dangerous. And we'll wrap up with the most important piece of all, the survival guide for the coming storm.
All right, first things first. We have to make a really critical mental shift here. You know, in a decade that's going to be this volatile, trying to predict the future, that's a fool's errand. The real edge, the real strategic advantage, comes from building resilience, from preparing for what could happen, not just guessing what will. And this slide just nails that mindset shift. See, on one hand, you have prediction. That's the crystal ball approach, and we all know it shatters at the first sign of real trouble. But on the other hand, you have preparation. Think of it like a pilot's checklist. It's methodical, it's all about anticipating the known vulnerabilities, and it makes sure you can handle turbulence no matter which direction it comes from.
And that, right there, is the core of our whole war game today. We're going to walk through 5 very distinct scenarios, but remember, and this is key, these are not predictions. Think of them as stress tests. They are designed to push our strategies right to their breaking point so we can see where the weaknesses really are.
Okay, let's get into the acute shocks. I want you to picture these as a line of financial dominoes, all perfectly set up, just waiting for one little nudge to set off a chain reaction that could rip across the globe with unbelievable speed.
Our first domino is in Japan. It's the potential unwinding of the giant yen carry trade. Now, for decades, investors have basically used Japan as a source of free money, borrowing yen at super low rates to go make riskier bets everywhere else. This has created this massive coiled spring of leverage in the system, and if it snaps, whoa, the recoil is going to be felt absolutely everywhere.
And this is how fast it could all go down. It's a 3-step cascade. 1. The Bank of Japan tightens. 2. The yen surges. And 3. Boom! Those free money trades instantly become toxic. That triggers a global fire sale, forcing investors to dump everything, stocks, bonds, you name it, creating a tidal wave of selling that could swamp the markets in literally a single day.
All right, our next scenario. This one hits right at the bedrock of the entire global financial system, U.S. Treasury bonds. I mean, for as long as we can remember, they've been the ultimate safe asset. But what happens when that bedrock starts to crack under the weight of an unsustainable debt load?
This chart, wow, it tells a pretty stark story. Before the 2008 crisis, U.S. debt was at 64% of its economy. Today, it's over 120% and still climbing. You know that fiscal space they talk about, the ammunition governments use to fight off recessions? It's gone. The arsenal is basically empty, right as new threats are starting to appear on the horizon.
And here's the really terrifying part. A political soap opera in Washington, D.C. could ignite a completely mechanical global financial meltdown. A fight over the debt ceiling makes treasury prices volatile, but because those same treasuries are the collateral for trillions of dollars in trades around the world, that volatility triggers a cascade of margin calls, forcing a massive, worldwide fire sale.
Okay, let's shift our focus over to Europe, where the old wounds from the sovereign debt crisis, they never really healed. The fundamental flaw of the Eurozone, having a single currency without a single treasury to back it, that's still a ticking time bomb right in the heart of the continent's economy.
This is that infamous doom loop you hear about. It starts with a political crisis in a country like Italy, which sends its bond yields soaring. European banks, which are loaded up with that same debt, take a massive hit to their balance sheets. So they stop lending, the economy grinds to a halt, and that makes the debt crisis even worse. It's a vicious cycle that got patched up, but it never actually got fixed.
Our final acute shock takes us to China. There, a slow-motion demolition of its property sector is threatening to become a full-blown collapse. I mean, with so much of the country's wealth tied up in real estate, the line between a managed slowdown and just total chaotic implosion is razor-thin.
And because China makes up a staggering 18% of the global economy, its problems very quickly become everyone's problems.
A Chinese slowdown crushes commodity prices, which hammers exporters from Australia to Brazil. It sparks a capital flight from other emerging markets, and it forces a painful repricing of growth expectations in every single stock market on the planet.
So, up to now, we've been looking at these sudden shocks. But not all threats are explosive, right? Some are more like a slow poison, a chronic condition that just grinds away at your wealth over years, not days.
We're talking about the economic monster of the 1970s, stagflation. And there's a growing fear that this beast is starting to stir from its slumber. It's the ultimate economic nightmare, right? Prices are soaring, but the economy is sinking.
Now, what makes stagflation so uniquely terrifying for investors is that it completely shatters the one rule that has protected them for a generation. See, in a normal recession, stocks go down, but bonds go up, and that provides a cushion. But in stagflation, everything falls at once. Stocks get hammered by inflation and weak growth, and bonds get hammered by the high interest rates you need to fight inflation. There's literally nowhere to hide.
So this is like the after-action report from our war game. And when you look at it, two things are just blindingly obvious. First, the traditional 60-40 portfolio, the bedrock of investing for decades, it gets hammered in every single one of these scenarios. And second, market volatility, that fear gauge, it spikes into the danger zone across the board. In this new world, there are no safe harbors.
Okay, so after surveying all these potential battlefields, the critical question becomes, how do you build a portfolio that can not only survive, but actually thrive in this kind of environment? Let's open up the survival kit and look at the principles of resilience for the decade ahead.
This slide right here might be the single most important takeaway from our entire analysis. The traditional set-it-and-forget-it 60-40 portfolio is a glass jaw. It's vulnerable in every single scenario. The future, it seems, belongs to strategies that are volatility-aware, the ones that can adapt to and maybe even harness the energy of the market. They are the ones that prove robust time and time again.
So what's the actual DNA of a robust strategy? Well, it has 5 key traits. It doesn't rely on old assumptions about how stocks and bonds should behave. It's constantly measuring and adapting to risk. It makes money from the size of market moves, not by guessing their direction. It's built to survive the worst of times, not just the good times. And it's systematic, which takes that dangerous human emotion out of the equation right when it matters most.
And that really brings us to the final, critical question you have to ask yourself. The old structures of the market are weakening. A tremendous amount of energy is building up, and it's about to be released. So is your portfolio built to be a victim of that energy, or is it designed to capture it? The choice you make is going to define your success in the decade to come. Thanks for joining me for this explainer.